So since the conflict of Russia and Ukraine since 2022, India has become a significant buyer of Russian crude, and it proved beneficial for the OMCs in the 2022-2023 period, which was evidenced by their supernormal gross marketing margins. However, despite the rising share, the benefits might have narrowed. Now, when we talk about Russia's share, Russia's share in the Indian total crude imports has risen from 1 to 2% prior to 35% in the 10 months of FY24. And when you look at the total import bill in the April 23 to Jan 24 period, while the total import bill has gone down 15.5% and key import and suppliers, the import bill has come down. For Russia, there's a 65% gain. But the benefits has narrowed. Now, Kotak notes that the overall benefit has reduced by $2 per barrel in FY24. And when we compare India's average Russian crude import price to the Dubai benchmark, which is basically, it sets the base for most Indian crude imports. Now, discount enjoyed in FY23 was around 12.2 per barrel. However, in 9 months FY24, the average Russian crude import price stood at 75.9 per barrel versus the Dubai crude benchmark, which averaged at around 82.7, resulting in a 6.8 dollar per barrel discount. So there has been a decline in the discounts enjoyed by 5.5 per barrel. Now, when we talk about how much Russian crude do Indian refineries use, while we don't get the exact data, port-based data suggests that over 2/3 of the Russian oil imports arrive at Gujarat port. There's low Russian crude usage at Hindustan Petroleum's Mumbai refinery, around 8 to 10%, says Kotak, while for Bharat Petroleum, it goes around 12 to 15%. However, in Hindustan Petroleum's Vizag and Bharat Petroleum's Kochi refineries, they tend to have a share at 31 to 32%. But according to Kotak, independent refiners like Naira Energy, Mangalore Refinery and Petrochemicals, and Reliance Industries are likely to benefit more from the crude. And lastly, when we talk to the main top 3 oil marketing companies, when you compare them to the Dubai benchmark, the OMC's reported raw material costs have dipped, but it's not a significant decrease. Now, OMC crude costs in FY23 stood higher than the average that you saw between FY17 and 21, says Kotak. And the benefits stand the least for Hindustan Petroleum, whose costs have risen at $12 per barrel versus the average premium of $5 in from FY17 to 22. But Bharat Petroleum is the OMC where Kotak states stands to benefit the most from the Russian crude discounts. It's benefited the most from the crude usage in terms of raw materials have not increased significantly. And lastly, for Indian oil, the benefit stands not as high as Bharat Petroleum, but definitely more than Hindustan Petroleum.
Okay, so HPCL benefits the least, BPCL quite a bit. Okay, now this is a spotlight on OMCs, but Mihika, while we have you, and I'm going to request the producer to put the Morgan Stanley note on GAIL behind Mihika on the wall as well. What does that note say? Because that stock is trading at the day's highs now.
Yes, so it's maintained an overweight on GAIL and a target price of 254%, which is a 33% upside to the previous close. Now it expects GAIL's EBITDA as well as market cap to double in 2026. India's gas push, which is, and it expects, Morgan Stanley expects this to increase from 6% currently to 12% by 2030, and GAIL will benefit as a pipeline player and from an earnings perspective. Monetization of assets as well as the chemical upcycle to help doubling the EBITDA by FY27. Additionally, the GAIL has already invested $7 billion in the past decade to expand its pipeline, and additional $1 billion in its chemicals, which will help the EBITDA to double. They expect a 13% CAGR in the next 3 years, and they also believe that GAIL is currently capitalizing on the $10 billion investments, and they've noted multiple underappreciated areas that could drive an upside. This is mainly gas transmission volumes, stability in the gas marketing segment, pipeline tariffs that will come into play, and a mix of all of these would will be key to re-rating.
Okay. Mihika, thanks a lot for that. So that's oil and gas in focus, OMCs plus Gas Authority of India. Now, before I come to it, fundamentally, Hemen, I'm leaving out the OMCs. I want to talk about GAIL because it's had a trending day today. It's closing in as we speak at the day's highs. Do you think the charts suggest that they could do more?
Neenaj, I think so, because GAIL was between 166, 196. It's consolidated, Neeraj, for 336 and 3, almost 9.5 weeks, Neeraj, within this range, and now we've broken out. So it's not being, just floating on thin air. It's made a base, it's made a foundation. Now it's breaking out, and the volume today is highest in what? The last almost 28 trading sessions. So I'd say further upside, we are heading towards 226, the way I see it, Neeraj.
And Pankaj, what about oil marketing companies?
Neeraj, I think there are a couple of things which are working in favor for these companies. One, I think one needs to understand that most of these companies are looking to sort of change their business model towards the renewable side. I mean, be it a gas company like GAIL, because it is very much possible that 15 to 20% kind of a blending can happen in their pipelines with the existing natural gas. So obviously that makes the business more, gives a lot more longevity. I think something similar can happen with OMCs also, from the perspective that a lot of these petrol or fueling stations, I think a lot of them can tilt towards the renewable energy side and providing a sort of a longevity to business growth. So what it does is that from single digit multiple, mid single digit multiple, you go to high single digit kind of a multiple or probably more. For gas company, I think what is good for a GAIL company like GAIL, what is good is that the gas prices have sort of stabilized. So both your key business verticals, one is the trading part, has started to sort of do better, and the transmission also is expected to sort of do better. So you are seeing a normalization of business for this company, and I think for oil marketing companies, I think at $75, some of these refiners were making 8 to 9 rupees per liter on the marketing side. But obviously, since the crude has sort of inched up, that leg of the benefit is not so much. But the refining side continues to remain good thanks to cheaper Russian crude. But I think our order of preference within oil marketing companies would be, see, HPCL will be the least preferred, given the fact that for them they've got a higher marketing capacity compared to refining side, and IOC being the most beneficiary. So BPCL lies in between. But in general, I think if they're sort of changing their business model on the renewable energy side, I think the re-rating possibility is very much on the card. Some bit of it has happened, and it is possible to sort of get a further re-rating is possible. I think crude oil prices down or higher, or gas prices sort of normalizing, I think we'll have a limited benefit in the near to medium term. But re-rating will happen only when the renewable energy side or the green side of the business takes shape.